Anybody can become an investor. I want to show how do you become an investor. So what do you mean by discretionary expenses? These are expenses that come, maybe your fridge is not working, or you realize it's small, you need to upgrade, or there's something you need to acquire. You don't have to borrow to acquire that thing today, but you can plan for that thing. And here, these discretionary expenses, they are the things that throws you off the budget. Kitu moja nilikuwa nafanya something this month, I don't have money. I spend my money on something, so I'm done. I'm broke for the next of the month. I'm waiting for the next payment. So I can take an advance, I can take, So what I'm saying is, these discretionary expenses, you can plan. If it's something, let's say you want to upgrade something or you want to acquire something, you can have a budget how you can acquire that thing. So you plan and say, this thing is going to cost me 20,000, maybe a cooker or something, and always check where you have best prices and all that. So, and if you're buying something, sometimes, like when I was talking about shopping here, try to identify where can I buy if it's something I can buy in bulk and avoid buying one item and all that. Can you identify where you can get it? So discretionary, let's say something I did actually, that was just buying I was buying a cooker at some point. Is it a cooker there? Whatever. So I think I went to Carrefour. They had a good offer and all that, and then they were giving a payment plan. I mean, give me a 4 months payment plan. Not that I didn't have that money in my pocket to buy it that day, but I told them, what are the opportunities? It's a payment plan. You give me 4 months. I'm not buying this thing. I go with it. I'm not in a hurry. So I told them, if I put this money deposit, then the rest I can pay on a monthly installment. In 4 months' time, I can be able to come and acquire it. Tell me yes. And there's no increment in the price. If you buy it today, and the same price will apply. If you put a payment plan, then I told them, give me a 4 months plan. So I paid actually, I think 4 months. Yes, I was sending them money. Then when I was going to pay the last installment, I went, put there whatever, my cooker, and went with it. It wasn't an emergency, but it was a deal I had seen, but I wanted to acquire. The money I had, if I were to buy that because I've seen a discount, I want to acquire, go with it home, that money I put it in money market. It was earning me maybe 200 shillings a month. That 200, by the time I went, maybe it's the one that took care of the transport. So what I'm trying to tell you is, if something is not an urgent, yes, you want it, but how can you plan to acquire it? Don't stop paying the school fees to acquire that thing. We call it depreciable assets. The moment you buy that cooker, you buy that fridge, you step out of that door, it has lost almost 50%. If you want to sell it, you can't sell it the way it was inside there. Those are depreciable. They depreciate in value. But if you buy something else that is appreciating in value, you see, if you borrow money, I'll talk about debt. Debt is good and debt is bad, depending on how you use that money. If you borrow money, let's say, I borrow money. Let's say I've gone out with my friend. I've realized, hey, these are my friends. Our friend said that unataka kuwabaia moja mbili. Then I realized, hey, I don't have cash. So I go to my KCB M-Pesa, toa 5,000, guys, wapewe. What have I done? I have borrowed money at an interest to consume. I'll need to pay this money back plus an interest. Very simple. So if you borrow money to consume, that's a bad debt. If you borrow money for an investment, let's say even for an education, maybe you are educating your children, you are in a circle. So you contribute something to a circle, and then beginning of the term you go and acquire, you borrow some money, pay the school fees for the term, and you continue saving in that circle, then you'll come and borrow. That's a good investment. You're equipping your children. There's a value, you see? But if you borrow that money, go buy that TV and put it there, it's a good screen, the children will watch, they are happy and all that, it has lost value. They will be happy, but what's the value of that watching? You are left with a loan paying interest. So discretionary expenses, these ones, you need to plan them. Plan them as much as you can. Okay? And when you have a budget, you'll not find yourself adjusting lifestyle. You know, money has come, let's do this. Money has come, you know, twende Mombasa, holiday, nini. You'll plan that. So budget, that's one of my assignment I will give you. I may not come and assess, but my request, be honest to yourself as much as you can and work towards increasing this passive income. And anybody can become an investor. I want to show how do you become an investor. We always hear an investor, we think of the late Dr. Chris Kirubi, we think of James Mwangi, we think of who else? Jim Nabaro, we think of Monga. Who are these guys? Manu Chandaria, Bimal Shah. Those are the guys we think, the investors and all that. But you know you can become an investor. I want to take you to this graph. So you have something here called income age graph. Yeah? And what's trying to say is that this is your age. This is your age on this side. And here you're starting to get income. So, as you start here, you have no income between 0 to 25 years. We are assuming you are dependent in school, college, and all that. So you're depending on someone. Someone is taking care of your bills and all that. Between age 25 to 55, between here you started working, you know. Here you started working. So you are building. This is what we call accumulation phase of your life. This life here, what you do here will determine the kind of life you'll have on this side. As you retire, you start drawing down on what you've been building. This is very important. As you hit at retirement there between 50, 55 there, the rest of the part of the year between now getting to 70 and 80, which is now here 70 and 80, you are drawing down what you did on this part here. So if you make a mistake here and you don't correct it with the time, you continue with that trend, it will mean you'll end up on this side. Something Madam Victoria said about people at this time, you'll have to ask your children, take care of me. I educated you guys, I took care of you, now it's a time for me, for you to take care of me. Things are changing. They may not. They also have right now, everybody has a burden. You know, they also have a burden. So what we are saying is, you need to plan your retirement. Whatever you're doing between this stage here, it will determine the quality of life that you'll have in this part here. So you need to do things different here. Manage your money well. Invest as much as you can. You know, passive income. Build passive income here, because this is what will take care of you on this part at the retirement. So that's what I wanted to say. This is a spending phase. You are spending whatever you are accumulating on this side. So if this side you are not accumulating, what are you going to spend? When you get here 50, 55, that's when you need mwili. You know, that's the aging part. The body will not be strong enough to work the way you are working. That's the time you need to do checkups. You know, body is reacting and all that. You need to go hospital, get checked and all that. So between here and there, the quality of life you live, it's gonna be determined by what you're doing between today and this time. So you need to do things different. That's one thing I wanted to highlight. Go to the second phase, whereby we are discussing active and passive income. This is the goal. If you don't get anything else, today get about how do you build a passive income. And I've shown you, first of all, it is to overcome the law of money, which says that as long as your income is increasing, you're increasing your expenses to meet the new level of income. So you have nothing left to be invested or to save. But now we are doing the budget. That's one of the things, and that's why I've asked you, go sit down and do it. Faithfully, honest, and tell yourself, this is where I've been going wrong. This is the budget I am. This is where I need to work hard. This is where I need to work on my income and all that, and manage my expenses. So the next slide, we have active and passive. I said about active, you work for money. You're working. As long as you're not working, you're not paid. There's no money that will reflect in your bank. When you go to an ATM, there will be no money. Why? Because you didn't work. That is active income. But there's another money. Let's say you bought what? Let's even say Safaricom, despite the way it's a bit down right now, it's been hitting even 40 shillings, 44 and all that. And it started at 5 shillings. Let's say you bought Safaricom at that time of 5 shillings, the time of IPO. And with the time, it has gone all the way to 30, 40, and it's been paying dividends. You by the fact that you bought a share Safaricom, or you bought equity, or you bought KCB, you own the company. The people who work there, they work for you. There are people who say, me, I own bank. Me, I own Google. I own Amazon. I own whatever, because I bought into share of the company. The company is doing well, I get paid my dividends. If I want to sell, I can sell by the appreciation. Maybe I bought it at 5 shillings per share, I've sold it at that shillings. That's an investor. That's a passive income. Money coming even when you're sleeping. People working for you. Yeah? So that's a goal. That on the first side, you are employed. And that's what I'm saying. On this phase, you are employed. You see that too, that mzee there, that photo. On this side, you are, on the ENS, you are either employed or self-employed. That part of it, you have to work, you have to open your shop, you have to, you have to work and to get paid. On the other side, we have a passive income. And a passive income, we either have a big business that you have set systems in place, let's say like Google, or let's say even Amazon, or let's say Safaricom, or let's say, the person has put a place, I'm looking at it, you've put systems in place, people are working every day, and you are getting returns for the money that you committed in building maybe that business. It's big, it has systems and all. You can afford to take a holiday and go to wherever you want, and people are working for you. But if you don't have that capacity of getting there, you can become an investor. The last person there, we are saying, they are the people that have money working hard for them. They play golf and live a good life. Yeah? In the morning, you are coming to work. Someone else has whatever golf junior Nigeria, Mudaiga Golf Club. Why? They have investment everywhere. They are giving them a passive income. Passive income, money is coming, So that's the goal. And the advantage is everyone can transition from being an active income earner to a passive income earner. You have that chance. And how do you become? You may not own a business, but you can become an investor. And the journey to become an investor, it is first of all paying yourself. Simple. Paying yourself, because if you spend that money, it's a seed that you're supposed to be investing for building the passive income. If you spend it today, then that means tomorrow you don't have a passive income. So you can become an investor. And how you become an investor, whatever we said pay yourself should not be kept in the bank. Don't be happy by looking at your phone or accessing your phone, your application, maybe your app, and see your bank mobile app and say, hey, I have 20,000 in my bank. You are not rich. You are not doing well if you are looking your wealth on your phone and you are saying, this is my money there. That money should be invested. That money should be invested somewhere, because as long as your money is accessible, you'll always access it. The law of money is very strong. As long as that money you can see it on phone, you'll always find yourself accessing that money. An emergency has come, spend that money. But if that money was invested somewhere, by the time you think, can I call Moses and start thinking of withdrawing my money at Nabo? Can I call our chairman in our investment chairman and tell him I want to check out? You get many solutions. You are trying to distance yourself and your wealth such that you're not disrupting that wealth creation journey. So have that money invested, and whereby it is growing over and above. If you have your money in your bank, what is happening to your money? One, you are losing your, what you call, there's something we call inflation. Why is bread right now costing how much? 60, 70, yeah? Let's go back. Let's go back just to ask a general observation, eh? 70. Nasikia how iko 70. It is at 70. So it tells you, no, you are now. So what has happened to that bread? Go back and think when you were in high school. How much was it costing then? Yes? 20. How much was it? 20. Yes? 7 shillings, 50 cents. It tells you how back you were. You know, nah? It's the same. 20, 23. I remember buying it, that price. You know, natumwa mkate, you buy whatever. From those time, I remember hata ulikuwa natumwa sukari, sijui kiberiti, and I think there was a 20 shillings, ile time ya Moi. Those times and all that, eh? What has happened? The bread in terms of the grams has not changed. It is still the same. In fact, it is reduced, eh? Right now, it's less than that, and even costing more. What has happened? So what has happened? The cost has gone up. So it means if today we talk of inflation at 9%, let's even say 8.5 is 9% to 9% there. What are we implying when we say inflation? Is that on the business news you hear with these guys in TV and say inflation has been projected to be at around 9% or at 8.5%. What does that mean? It means your money, this is an enemy to your money, because it means the purchasing power of your money has reduced. If you had 100 shillings, you may think you have 100 shillings on your phone. You can see it this way. But in terms of the purchasing power, your money has lost. So if it is 9 shillings, your money the value of the goods your money can buy is something like 91. Because the inflation is at 9%, so it's 100 shillings minus this 9%, which is 9 shillings that you have lost to the inflation. So your money is only able to buy 91 shillings. So when you keep the money, this is what is happening to your money. You keep it in your bank, the bank takes your money, lends people at credit, they borrow your money, you will see it, your balance there. Your balance is there, but that money is not kept in the bank. It's not there. Maybe your money is somewhere to someone borrowed. Is even building roads and doing other projects there. They will pay the bank at an interest. But you will come and say, I want my 20 shillings. They'll pay you because another person came and gave the money. This is what we call credit creation. So this money that is there, seated there in your bank, and you say, I have 50,000 seated in the bank, that's my savings. It's not a savings. It may be a savings, but it's not an investment. That money is not worth 50,000, the way you call it. Maybe it's worth 40,000 because of the inflation. So what am I trying to say? You need to shift from being a saver to an investor.